The Valley Current.
Imagine, if you will, a $2.15 trillion mega conglomerate. I mean, just to even visualize that amount of wealth it's difficult, right?
Yeah, absolutely. It's astronomical.
Like, we're talking about combining the GDP of a major developed nation into a single corporate entity. Specifically, we're looking at a theoretical merger between the world's most famous electric vehicle maker and a privately held orbital rocket giant. Two companies that have completely shattered the paradigms of their respective industries, just, suddenly operating under one unified corporate umbrella.
Right. And it genuinely stretches the limits of, modern market mechanics.
Yeah.
You're looking at a scenario where a publicly traded automaker, which is hovering around $1 trillion valuation, absorbs or merges with an aerospace manufacturer that just recently crossed the $1.1 trillion valuation mark itself.
Which is just wild.
That is. We really haven't seen an industrial consolidation of this physical scale since, maybe the Gilded Age monopolies, and certainly never with this level of frontier technology.
Yeah, I love that framing because on its face, to a casual observer, merging cars and rockets sounds like science fiction. Or, worse, it sounds like one of those late-night internet forums where people just smash two cool things together and say, what if?
Exactly. The whole internet speculation machine.
Right. But we aren't here to entertain internet rumors today. We are doing a deep dive into a highly rigorous, really fascinating brief published on July 23rd, 2026 from the Entrepreneur Law Group, written by Jack Russo. And this brief takes the mounting evidence, all the incredibly complex legal maneuvering behind the scenes, and the raw strategic logic of a Tesla and SpaceX merger, and just lays it all out.
Which is vital for anyone trying to navigate the current information ecosystem, Whether you are holding equities in these sectors, or maybe you work in telecommunications, or honestly, if you're just a person trying to survive a news feed that is currently flooded with AI-generated garbage, you have to have a mental framework to process this.
Yeah, totally.
We really need to look at the cold, hard mechanics of corporate law to understand what is actually happening behind the smoke.
So let's start with the immediate spark. Because this updated legal brief didn't just, drop out of a clear blue sky. We are recording this deep dive just after Tesla's July 22nd earnings call. And from what I understand, this call was not your standard boilerplate quarterly update at all. It sounded like a structural earthquake disguised in the most boring corporate jargon imaginable.
Yeah, it really was. The market tuned in expecting the usual dance, right? Analysts wanted forward guidance on vehicle delivery numbers, maybe some updates on the capital expenditures for their AI compute clusters, just, normal quarterly housekeeping stuff.
Right.
But instead, what they caught was a momentary glimpse into the architectural foundation of what could be the largest corporate combination in modern history.
I want to pull on that thread because the catalyst for this whole frenzy was a very specific exchange. An analyst got on the line and asked a direct, pointed question about a potential combination with SpaceX. Now, I've listened to hundreds of earnings calls. Usually, when a CEO is asked about a wild rumor, they have a script, right?
Well, absolutely. They have the standard PR deflection ready to go.
Exactly. They say something like, we don't comment on market speculation, or we have no plans for M&A at this time. It's a quick swat of the tennis racket and you move on. But the principal in this case, Elon Musk, gave a highly specific answer.
He did. And honestly, the phrasing is everything here. For anyone who didn't read the transcript, Musk cited, and I'm quoting here, more and more overlap, especially with Terafab, which is their joint chip mega facility. And then he stated that a combination can't be discussed on an earnings call, but that it has got to be done with the appropriate process.
Okay, let's pause right there. If I'm an average retail investor listening to that on my drive home, I just hear, I can't talk about it. And I probably brush it off as a non-answer. He's just deflecting, right?
See, that is the genius of the phrasing. To the layman, it absolutely sounds like a deflection. But to a securities lawyer, or anyone familiar with Regulation FD, which stands for fair disclosure, it reads like a flashing neon sign.
Oh, interesting. How so?
Well, under SEC rules, a corporate officer literally cannot selectively dribble out material, market-moving deal information during a Q&A session on a public earnings call. If a massive merger is actually being negotiated, you cannot hint at it casually. It violates fair disclosure.
So saying I can't discuss it here isn't him being evasive. It is a strict statement of legal fact. If a deal were happening, he legally could not tell that analyst on that call.
That is the first layer, exactly.
Right.
It's just compliant caution. But the true meat of the statement is the second half, where he says it's got to be done with the appropriate process. In the realm of Delaware and Texas corporate law, particularly when you're dealing with what we call a conflicted controller transaction.
Wait, a conflicted controller? That means one person heavily influences both companies, right?
Right, exactly. One person is heavily influencing both the buyer and the seller. And in that situation, the phrase appropriate process is not a casual choice of words at all. It refers to a highly specific legal mechanism. It involves setting up a special committee of independent directors and requiring a majority of the minority shareholder vote.
Okay, that reminds me of the dinner party analogy from the ELG brief, which honestly made this click for me instantly when I read it.
Oh, it's such a good analogy.
It really is. Imagine you are at a crowded dinner party and you ask a friend point blank if she and her partner are finally engaged. If she laughs, holds up her hands and says, look, we can't announce anything at a dinner party. It has to be done properly. She technically hasn't said yes.
Right.
But she definitely did not say no. She just told you how she plans to announce it later.
That's a fantastic way to look at it. You leave that dinner party knowing full well to watch her left hand over the next few weeks. In the corporate world, the equivalent of that engagement ring is an S-4 filing, which is the SEC form required to register a merger.
So when Wall Street heard that specific phrase on the call...
Oh, the algorithms and the analysts immediately started pricing in the possibility. I mean, G. Munster, who is a highly respected tech analyst at Deepwater, raised his probability of a combination in the next few years from 80% to 90% within hours of that call.
Wow, just based on that wording. But we also have to look at the financial vulnerability that might be forcing this conversation to happen now, in the summer of 2026. Because Tesla's Q2 operating margin fell to 1.4%.
Yeah, that was a brutal number.
For a company that has historically commanded this massive valuation premium because it was viewed as a high-margin tech stock rather than, a traditional metal-bending automaker, 1.4% is a catastrophic drop. Operating income was down 57% year over year.
And this brings us to a phenomenon the brief highlights regarding their accounting entanglement, which is fascinating. Tesla reported a GAAP net income for the quarter of $1.11 billion. So on paper, that looks like they're staying above water, right?
Sure, $1 billion in profit sounds great.
Right, but here's the catch. Roughly $750 million to $1 billion of that reported profit was actually a mark-to-market paper gain on Tesla's existing stake in the SpaceX.
Wait, hold on. Explain that to me like I'm a beginner. Because that sounds like financial alchemy. Does that mean the money isn't actually cash sitting in their bank account?
It is entirely alchemy. In simple terms, mark-to-market accounting means you adjust the value of an asset on your balance sheet to reflect its current market price.
Okay.
So if you own a house, and Zillow says it went up in value by $50,000 this year, you didn't actually make $50,000 in cash, right? You can't take that Zillow screenshot and spend it at the grocery store.
Obviously not, yeah.
But under certain corporate accounting rules, Tesla can claim the increased estimated value of its privately held SpaceX shares as income on its quarterly statement.
So I'm understanding this correctly. Almost all of their reported profit for that entire quarter was just a paper illusion. Just because the rocket company they happen to hold some shares in went up in estimated value.
You hit the nail on the head. And the situation is actually more precarious than that. Because SpaceX's internal stock valuation reportedly declined about 7% in the weeks following that earnings call.
Oh, no.
Yeah, so that massive paper gain is already positioned to reverse in the next quarter.
Mm-hmm.
We are looking at a scenario where Tesla's earnings quality, like their actual ability to report a profitable quarter to Wall Street, is now materially dependent on the valuation of the very company they are rumored to be merging with.
That is genuinely wild. The financial destinies of the car company and the rocket company are already so intertwined that you basically can't untangle the spreadsheet anymore.
Exactly.
But, okay, if the earnings call gave us the how, the appropriate process, we have to step back and look at the why. Why on earth would you jam these two massive, completely distinct industrial operations together?
Well, the cynical view is that a CEO simply wants to consolidate his empire for vanity, or maybe to hide the margin compression of the auto business we just talked about.
Right, just a shell game.
But the brief actually steelmans a much larger, much more ambitious industrial play. The strategic thesis here is that they aren't just building cars and rockets anymore. They are secretly constructing a carrier bypass, satellite-first telecommunications, and hardware ecosystem. And the ultimate target of this massive ecosystem, it's Apple.
taking on Apple and consumer hardware. I mean, that's the tech equivalent of a land war in Asia. It is notoriously impossible. Apple has a fortress monopoly on the smartphone market in the US, so how does a car rocket merger change that math at all?
To crack Apple's fortress, you can't just build a better phone. You need a completely independent ecosystem, so you don't have to rely on their rules or their app store. The brief outlines a 6-ingredient matrix that is required to pull off a true carrier bypass strategy.
Okay, let's walk through this matrix, because when you lay it out ingredient by ingredient, the picture gets incredibly clear. So ingredient 1, spectrum and low Earth orbit capacity. You need the pipe. You need to be able to connect devices to the internet without relying on AT&T, Verizon, or Apple's infrastructure.
And SpaceX owns this ingredient completely. With the Starlink constellation, they already have thousands of low Earth orbit satellites in place. They have the direct-to-cell authority from the FCC, and they have the global telecom interconnect agreements. Tesla, on its own, has absolutely none of this.
Right. Ingredient 2, handset silicon and an operating system. You need the actual physical device in the user's hand and the software to run it.
Here, the assets are split between the two. SpaceX allegedly has a physical prototype handset running a proprietary operating system, at least according to recent Wall Street Journal reporting.
Oh, okay.
Tesla, conversely, brings massive silicon expertise to the table. They have the Dojo supercomputer architecture, the hardware 5 in-car silicon, and a highly mature over-the-air software stack that has been running flawlessly on millions of vehicles for a decade. And they also share that massive terafab chip facility.
Got it. Moving to ingredient 3, the AI and agent layer. A modern ecosystem needs a brain, right? Like a digital assistant that actually works.
Exactly.
Yeah.
SpaceX absorbed the xAI startup earlier in 2026, which gives them the Grok large language model and access to massive data center compute. But Tesla brings its full self-driving neural networks and the visual processing AI from the Optimus robotics program. So they complement each other perfectly.
Which brings us to ingredient 4, and honestly, I think this is the sleeper hit of the whole strategy: distribution.
Oh, absolutely.
Because even if you build the best phone and the best network in the world, how do you get it into consumers' hands without relying on traditional carrier retail stores?
This is where Tesla's physical footprint becomes invaluable. Tesla has roughly 1,000 physical retail and service centers globally. But more importantly, they have roughly 7 million vehicles currently on the road right now.
Yeah.
Every single one of those cars is basically a rolling billboard, a mobile Wi-Fi hotspot, and a point of integration for a new device ecosystem.
It's a built-in user risk.
Yeah.
Okay, ingredient 5, energy. Running data centers, charging millions of edge devices, powering satellite uplinks, it all requires massive, vertically integrated power.
And Tesla is arguably as much an energy company as it is a car company. They manufacture Powerwalls for homes and massive megapack batteries for grid-scale storage. In fact, SpaceX is already a 9-figure customer, buying Tesla megapacks to power their own launch and data facilities.
That's a huge synergy right there. And finally, ingredient 6. A fortress balance sheet and brand trust. You just need infinite money and consumers who actually believe in your product.
Right. SpaceX has the trillion-dollar private valuation, the backing of massive sovereign wealth funds, and immense institutional momentum. Tesla has the global consumer trust, the brand recognition, and a proven ability to scale consumer hardware at a massive level.
So when you look at that 6-ingredient matrix, the punchline is undeniable. Separately, SpaceX holds maybe 4 out of the 6 puzzle pieces. Tesla hold a different 4 out of the 6. They're both incomplete on their own, but combined, they hold all 6.
It creates a perfectly enclosed ecosystem. You have the satellites providing the connection, the AI providing the software intelligence, the silicon processing the data, the cars providing the distribution, and the batteries powering the whole thing. It's end-to-end.
I have to play the skeptic for a second, though. I look at that matrix and I think, sure, that looks brilliant on a PowerPoint slide in a boardroom. But why do I, as a regular consumer living in a major city, actually need Starlink integration? I already have perfectly good 5G on my iPhone. Why would I care about orbital backhaul?
It's a fair question, and the brief anticipates that exact skepticism. It answers it not with theory, but with hard engineering reality from just days before that earnings call. Tesla officially confirmed that Starlink hardware is actively being integrated into their newly announced Cybercab fleet.
Wait, so they're literally bolting the rocket company's satellite dishes into the car company's new vehicle. How does that fundamentally change the product?
It solves the most critical point of failure for autonomous driving. Think about it. The Cybercab is a robotaxi. It doesn't have a steering wheel or pedals. Right. If you are a passenger in a vehicle with no manual controls, and that vehicle hits a cellular dead zone in a canyon or, rural highway, what happens?
Oh, I see. If it loses connection to the dispatch server or the remote assistance failover, you are just trapped in a rolling brick. You can't even steer it to the side of the road.
Precisely the issue. A driverless fleet requires absolute, unbroken, 100% connectivity. Traditional cell towers simply cannot guarantee that. There are always dead zones.
Yeah, that makes sense.
But Starlink's phased array antennas, communicating with low Earth orbit satellites, provide a blanket of connectivity that ignores terrestrial geography. It handles the fleet dispatch, the critical over-the-air safety updates, the remote assistance video feeds, and even high-speed Wi-Fi for the passengers.
So this isn't some distant 10-year plan. They're shipping the integrated hardware right now. And if they can deliver that kind of unbroken connectivity to a car, delivering it to a smartphone is really just a matter of miniaturization.
Exactly. And the addressable market here is staggering. The brief points out that roughly 400 million people globally live in areas with zero mobile coverage whatsoever. And another 3 billion people experience regular daily gaps in service.
3 billion, wow.
Yeah. If a combined Tesla SpaceX entity can capture even a fraction of that market, charging just, say, $2 to $10 of incremental revenue per user per month for direct-to-cell satellite service, you are looking at a $10 billion to $100 billion annual revenue stream.
And that is purely service revenue. That's before they even sell a single piece of physical consumer hardware.
Yep. And that recurring service revenue is a financial engine that bulls believe could subsidize a massive loss-leading push into consumer devices to finally rival Apple.
Okay, if we are going to talk about consumer devices, we absolutely have to pivot to what the brief calls the hype machine versus the loop. Because if this 6-ingredient strategy is real and they are genuinely building a telecom ecosystem, does that mean all those YouTube videos I keep seeing about a $199 Tesla Pi phone are actually real?
Oh man, this is where the legal analysis provides a massive public service. For anyone researching this potential merger, the internet is just a hall of mirrors right now. If you go on YouTube today and search Tesla satellite phone, you will be inundated with highly produced, incredibly convincing videos.
I've seen them. The thumbnails show these beautiful, gleaming smartphones with the Tesla logo sitting in retail packaging. The titles have these crazy claims like, Elon Musk destroys Apple. Or they promise the phone will only cost $169. One specific video, which I know the brief highlighted, promised that the phone would feature, quote, free service from carriers for seniors on Social Security.
It is entirely predatory, and every single one of those products is a complete fabrication. The brief does an excellent job of tracing the origin of this specific internet myth. The Tesla Pi phone did not originate in a Tesla engineering lab. It started years ago as a portfolio exercise by an independent digital designer named Antonio Russo.
Wait, really? So a random artist just made some cool 3D renders for his own website and the internet hijacked it?
Yes, exactly. He explicitly labeled it as concept art on his site. But algorithmic content farms, channels that exist solely to generate ad revenue from clicks, they stole those renders. They invented the fake prices, they layered on AI-generated voiceovers, making absurd promises about free satellite internet, and they discovered an absolute gold mine.
I mean, it makes sense economically for the scammers, right? If you put Musk's face, a shiny fake product, and an impossibly low price in a thumbnail, you are going to get millions of clicks.
Yeah.
And it costs them practically nothing to produce. I always call this the costume jewelry problem.
Oh, that's a good way to put it.
Yeah, like a fake diamond looks incredible from across the room. It glitters, it catches the eye. But if you take a jeweler's loupe, that little magnifying glass they screw into their eye, and you look closely at the facets, the illusion falls apart instantly.
The brief actually formalizes that concept into a 3-question framework they call the loop. Is a tool for investors to filter out the noise. The first question is, who is accountable?
Yeah.
Is the information coming from a named reporter at a legacy financial institution, or is it an anonymous YouTube channel with an AI avatar?
Right. And the second question is my favorite. What does it cost them to be wrong?
It is the ultimate test of skin in the game. If a Wall Street Journal reporter fabricates a story about a merger, they lose their career, and their publisher faces massive libel and securities exposure. If a YouTube content farm is wrong about the Pi phone, absolutely nothing happens. They just upload another fake video tomorrow.
Exactly. And the third question of the loop, is there a paper trail? Are we looking at SEC filings, registered patents, or physical prototypes shown to identifiable human beings? Or are we just looking at unsourced 3D renders?
When you apply the loop to those YouTube videos, they disintegrate immediately. However, the brief contrasts this internet slop with a legitimate piece of reporting from the Wall Street Journal in July 2026. The journal reported that SpaceX investors were recently shown a slim, proprietary OS handset prototype behind closed doors.
So wait, the fake internet rumor might actually have a kernel of real-world truth now.
Yes, and the Wall Street Journal report passes all 3 tests of the loop. It involves named reporters, massive reputational risk, and human sources verifying a physical prototype. Now, the brief carefully categorizes this as contested rather than established fact because it relies on single-source reporting, but it represents real evidentiary weight. It means engineers were actually paid to build real hardware.
But if the real reporting is out there, why does the fake internet slop continue to dominate the search results? Why hasn't anyone shut these content farms down, especially when they are targeting seniors on fixed incomes with promises of free phone service?
You're pointing out a massive regulatory blind spot at the Federal Trade Commission right now. The FTC has very strict rules regarding deceptive advertising. But those statutes were largely written for entities that are trying to actually sell you a fake product.
Right, like selling snake oil.
Exactly. But these YouTube channels aren't selling a phone. They are selling attention. They are harvesting clicks to serve you ads for unrelated products. The regulatory framework really struggles to penalize a channel for lying about a product they don't actually manufacture or sell. Furthermore, the platform policies at YouTube generally allow for speculation about future tech products under the umbrella of free expression, even if the premise is entirely fabricated.
The irony here is just painful. Because this fake PiPhone rumor has been circulating for 5 solid years, we have created a massive boy who cried wolf dynamic.
It is a fascinating psychological phenomenon. By the time the legitimate Wall Street Journal reporting about a real prototype finally surfaced, the general public was already conditioned to dismiss it. They'd seen 100 fake thumbnails, so they assumed the real news was just another scam. The genuine strategy was pre-discredited by its own counterfeit.
Which is exactly why we need a framework like the loop. You have to strip away the emotion and the YouTube algorithms and just look at the mechanics.
And that transition from hype to mechanics brings us to the most formidable obstacle this deal faces.
Yeah, let's get into that. Let's assume the strategy is brilliant, the hardware is real, the synergy of the 6 ingredients is undeniable. If I'm a logical observer, I'm asking, what is stopping them from drafting the paperwork and signing this tomorrow? Why the hesitation? That brings us to the trillion-dollar legal hurdle, which the brief refers to as the Solar City ghost.
Right. To understand the future of a Tesla-SpaceX merger, you really have to understand a relatively ancient piece of corporate history from 2016. The acquisition of Solar City by Tesla is the only legal precedent that truly matters here, even though it occurred at a fraction of the scale we are discussing today.
Walk me through the Solar City ghost story. What happened in 2016 that has everyone so spooked a decade later?
Well, in 2016, Tesla acquired Solar City, which was a solar panel installation company, in an all-stock deal valued around $2.6 billion. The structural problem was the massive overlap in ownership and control. Elon Musk was the chairman of Solar City, he had co-founded it with his cousins, and he personally held roughly 22% of its stock.
Okay, so he's heavily invested in the target company.
Simultaneously, he was the CEO of Tesla, holding roughly 21% of the acquiring company.
Right. From a layman's perspective, he is basically sitting on both sides of the negotiating table, passing money from his left pocket to his right pocket.
And that is exactly how institutional shareholders viewed it. They sued, alleging that Musk was acting as a conflicted controller. The plaintiffs argued that he was essentially using a healthy public company, Tesla, to bail out an insolvent family enterprise, Solar City, at the expense of Tesla's minority shareholders.
And because both companies were incorporated in Delaware at the time, this triggered a very specific legal mechanism, right?
Yes, it triggered a standard of review known in Delaware corporate law as entire fairness.
I mean, that sounds reasonable enough. You want a deal to be entirely fair.
The name is deceptive in its simplicity. Entire fairness is actually the most exacting, brutal, and invasive standard in corporate litigation. Normally, under the business judgment rule, courts defer to the decisions of a board of directors. But when a conflicted controller is involved, the burden of proof completely flips. The defendants, so Musk and the Tesla board, had to prove to a judge that both the process of negotiating the deal and the final price paid were entirely fair to the minority shareholders.
Meaning, the plaintiffs don't have to prove you did something wrong. You have to prove you did everything perfectly right.
Exactly the dynamic. And proving that took 6 years. It was a grueling ordeal that culminated in a highly publicized, multi-day trial in the Delaware Court of Chancery.
6 years of depositions, discovery, legal fees, and constant distraction for the executive team over a $2.6 billion deal.
Now, ultimately, the Delaware Chancery Court ruled in Musk's favor in 2022, and the Delaware Supreme Court affirmed that decision in 2023. The courts largely found that while the process was flawed, the price paid was ultimately fair, so no damages were awarded. But the brief makes a profound observation here. Musk clearly concluded that while he won the battle, the victory was absolutely not worth the 6 years of litigation hell.
Wow, okay, so if you know you want to merge your trillion-dollar car company with your trillion-dollar rocket company, and you know you are a conflicted controller in both, you weren't going to subject yourself to that Delaware meat grinder again. You are going to change the battlefield before you declare war.
That's it. The brief refers to this strategy as terraforming the battlefield. Over the past 2 years, we have witnessed a systematic, deliberate effort to renovate the legal environment to accommodate this exact type of transaction. And the catalyst for this exodus was a separate Delaware case called Tornetta v. Musk.
Was that the case regarding his compensation package?
Yes. A Delaware judge rescinded his $56 billion pay package, citing deep flaws in the board's independence. In direct response to that stinging defeat, Tesla held a shareholder vote and officially moved its state of incorporation from Delaware to Texas in June of 2024. SpaceX, which was already private, also reincorporated in Texas around the same time.
But just moving the corporate mailing address doesn't solve the legal problem. Texas still has laws, right?
This is where the terraforming becomes explicit. It wasn't just a change of venue. Texas fundamentally altered its corporate code. In 2025, the Texas legislature enacted Senate Bill 29.
Let's dig into SB 29 because this feels like the linchpin of the whole legal strategy.
It really is. SB 29 was a deliberate legislative bid by Texas to outcompete Delaware as the premier home for corporate America. It essentially built a massive, custom-fitted litigation shield for corporate boards. The statute codified safe harbors and business judgment presumptions that heavily favor directors, even in conflicted transactions.
Meaning that if a shareholder sues over a Tesla-SpaceX merger in Texas, the board doesn't have to face that grueling entire fairness standard where they are presumed guilty until proven innocent.
Right. The burden of proof would be significantly harder for a plaintiff to overcome. But SB 29 went even further than that. It completely rewrote the rules for what is called derivative standing.
Okay, what does that mean in plain English?
Derivative standing dictates who is legally allowed to file a lawsuit on behalf of the company against its own board. Under the old Delaware rules, practically any shareholder who held stock continuously through the transaction could file a suit. This incredibly low barrier to entry fueled an entire industry of plaintiffs' law firms.
So if I owned, 10 shares of Tesla, I could theoretically tie up a $1 trillion merger in court.
Under Texas SB 29, that is no longer possible. The new law allows public companies to amend their bylaws to require a plaintiff to hold up to 3% of the company's outstanding stock just to have the legal standing to file a derivative lawsuit.
Let's do the math on that. If Tesla is valued at roughly $1 trillion, 3% of the company is $30 billion.
Exactly. You would literally need to aggregate a $30 billion block of stock just to buy a ticket into the courtroom to complain about the deal process.
That isn't just a shield, that is a moat filled with alligators. It is designed so that the equivalent of the SolarCity lawsuit never even gets filed, let alone goes to trial.
The strategic foresight is remarkable, truly. But as an analyst, you have to balance the view. You cannot assume a deal is guaranteed just because the state law changed.
Why not? If they have the armor on, aren't they ready for battle?
Because untested law is always a wild card. Delaware corporate law is predictable because it has 100 years of case law backing it up. Texas SB 29 is novel. When you put a brand new statute in front of a judge in a high-stakes, highly publicized case, the interpretation can sometimes surprise the very people who lobbied for the law.
I see. You don't know how a judge will interpret the fine print until the ink is actually wet on the lawsuit.
Moreover, the statutory legal shield doesn't solve the immediate market reality. Tesla's shareholder base isn't just retail investors. It is dominated by massive institutional players. mutual funds, pension funds, index funds, and these institutions have strict internal governance mandates.
So Vanguard or BlackRock might look at the deal and say, we don't care what the new Texas law allows. If you want us to vote yes on this merger, we demand Delaware-style protections, we demand a truly independent special committee, and we demand that the merger requires a majority of the minority shareholders to approve it.
Precisely. The institutional gatekeepers hold the real power here. The board might be protected from lawsuits by Texas law, but they still need the institutional votes to actually close the transaction. And convincing those institutions to vote yes brings us to the mathematical nightmare at the heart of this deal.
Oh, we definitely need to talk about the math, because this section of the brief blew my mind. The structural conflict here is rooted in what we call the two hats problem.
It is the arithmetic that serves as both the primary motive for the deal and its most radioactive vulnerability. Musk wears the CEO hat at Tesla, and he wears the CEO hat at SpaceX. But his equity stakes beneath those hats are wildly asymmetrical.
Let's break down the percentages so people can visualize this.
Sure. Musk owns roughly 42% of the economic equity in SpaceX, and through various trust structures, he controls about 85% of the voting power. He essentially has absolute dominion over the rocket company.
And on the car company side?
At Tesla, his economic stake currently hovers around 13%.
So if I'm visualizing this, if SpaceX acquires Tesla in a stock-for-stock merger, the exchange ratio becomes the most heavily scrutinized number in financial history.
Yes, because the exchange ratio dictates how many shares of the new combined company a Tesla shareholder receives for their existing stock. Because of that massive asymmetry, 42% versus 13%, every single dollar that Tesla is undervalued in that transaction represents a direct, massive transfer of wealth from Tesla's public shareholders into Elon Musk's personal net worth.
I want to make sure I understand this completely. If the board agrees to sell Tesla on the cheap, Musk takes a hit on his 13% stake in Tesla, sure. But because he owns 42% of the acquiring company, the windfall on the SpaceX side massively outweighs his loss on the Tesla side.
It is the textbook definition of a zero-sum conflict. A bad deal for Tesla retail investors is an exceptionally lucrative deal for the conflicted controller. That dynamic is why the institutional investors will demand blood in the form of independent valuations and fairness opinions from investment banks. They won't just take his word for it.
The brief does provide some projections on what a fair merger might actually look like, assuming both sides negotiate in good faith, right?
It does. Assuming a relatively equal valuation, say, combining a $1.1 trillion SpaceX with a $1.05 trillion Tesla, the math dictates that legacy Tesla shareholders would end up holding roughly 48.8% of the combined mega entity.
And where does that leave Musk's personal ownership of the new conglomerate?
His pro forma economic stake in the combined entity would land somewhere near 28%.
Which is fascinating, because for years he has publicly stated that he desires roughly 25% voting control at Tesla to feel comfortable building artificial intelligence and humanoid robotics within the public company. A merger at this exchange ratio instantly delivers that exact level of control, organically.
It neatly solves his publicly stated control dilemma without Tesla having to execute a massive capital-intensive share buyback or attempting a highly contentious dual-class share restructuring, which institutional investors despise. The merger is mathematically elegant for the founder,
but incredibly legally treacherous to execute. And it isn't just corporate lawyers and investment bankers they have to appease. They have to survive Washington, D.C.
Oh, absolutely. The regulatory gauntlet is arguably more dangerous than the shareholder vote. The brief dedicates a significant section to what it calls the Washington variable, noting a very specific deal window that closes on January 20th, 2029.
The brief literally subtitles this section "While Trump is POTUS." And to be clear to our listeners, the brief approaches this from a strictly objective, nonpartisan, transactional perspective. That timeline isn't political commentary. It is a calculation of regulatory friction.
Exactly. When you attempt to combine $2 trillion entities, your first hurdle is always the antitrust regulators, the Federal Trade Commission, and the Department of Justice.
Normally, antitrust is about stopping monopolies, but cars and rockets don't compete with each other. If I want to buy a Model Y, I'm not cross-shopping it with a Falcon 9 rocket launch.
Which makes this an atypical antitrust review. It is not a horizontal monopoly where a company buys its direct competitor to raise prices. The theory of regulatory harm here would be conglomerate concentration. Regulators would have to argue that allowing one single entity to control orbital space launch, the dominant satellite telecom network, a frontier AI lab, a massive electric vehicle fleet, grid-scale energy storage, and humanoid robotics creates an unassailable tech oligarchy.
It sounds like a sci-fi megacorporation, but the brief suggests the current antitrust environment might actually look favorably on this.
The brief posits an intriguing counter-narrative, yes. While current antitrust leadership is famously aggressive against traditional big tech incumbents like Google or Amazon, a combined Tesla SpaceX could be pitched as a vital American champion.
Meaning it's a geopolitical asset.
Right. The narrative to regulators would be, you need a vertically integrated, domestically controlled hardware and telecom giant capable of competing head-to-head with massive state-backed Chinese conglomerates like BYD or Huawei. Don't break us up. Let us scale so we can protect American technological supremacy.
I can definitely see how that argument plays well in certain Pentagon briefing rooms, but that geopolitical angle brings us to the sleeper issue. The brief highlights this as the single most dangerous, silent roadblock to the entire deal: national security.
The collision of national security interests here is staggering. Let's look at SpaceX. They are deeply, inextricably embedded in the United States defense and intelligence apparatus. They launch highly classified spy satellites. They operate military-grade communications networks. They deal constantly with ITAR control technology, which is highly restricted defense data. They are a crown jewel of U.S. national security infrastructure.
And then you look at Tesla.
Right. Tesla operates its most productive, high-volume gigafactory in Shanghai. A massive portion of their global revenue is dependent on the goodwill of the Chinese consumer market, and their supply chain is deeply reliant on Chinese battery manufacturing and critical minerals.
The conflict is just glaring. You are attempting to bolt a highly China-exposed consumer automotive business into the exact same corporate governance structure that manages classified U.S. defense contracts.
In a traditional cross-border merger, the Committee on Foreign Investment in the United States, or CFIUS, would review the deal for security risks. Now, CFIUS might not have formal statutory jurisdiction over a domestic merger between two American companies, but the Department of Defense does not need formal jurisdiction to ruin a corporate timeline.
How do they stop a deal without officially blocking it?
Through what the brief calls clearance friction. The Pentagon can simply place a phone call to SpaceX leadership and say, if you merge your executive team and your IT infrastructure with this China-exposed entity, maintaining the top-secret security clearances for your key personnel and your launch facilities is going to become extremely difficult. It will trigger massive multi-year reviews, and it might jeopardize future defense contracts.
Wow. It's a silent veto. The threat of losing the defense contracts is enough to make the board abandon the merger.
And that fragility is compounded by the volatility of the relationship between the CEO and the executive branch. The brief documents how this relationship oscillates wildly between deep collaboration on national initiatives and very public acrimonious feuding.
Which brings us to the mountaineering analogy used in the text. I think about this every time a massive M&A deal is announced. The brief says, you don't summit when the mountain is easiest. You summit when the weather permits.
It is the perfect encapsulation of M&A strategy.
The legal mountain navigating the exchange ratio, surviving the shareholder votes, managing the conflicts of interest, that mountain is made of granite. It is constant. It is always going to be a grueling vertical climb. But the regulatory weather, the mood of the antitrust division, the comfort level of the Pentagon, the temperament of the president, that is entirely variable. The window is open right now, but a single geopolitical event or a bad meeting in Washington could cause a blizzard that shuts the mountain down for 4 years.
Which generates immense ticking clock pressure on the corporate boards. Deals with expiring regulatory windows usually result in a binary outcome. They get aggressively pushed through to completion, or they die completely. There's no middle ground.
Okay, we have established the massive strategic upside, the brutal legal hurdles, and the ticking regulatory clock. As a listener, as a retail investor or a tech analyst, how do I know when to actually pay attention? How do I filter out the endless noise on my timeline?
The ELG brief concludes by providing a highly calibrated probability framework. This isn't about guessing based on vibes. It is about watching specific, observable metrics.
Let's get to the numbers. What are the actual odds this mega merger happens?
According to the updated probability bands as of late July 2026, the brief assigns a 50 to 65% chance of a formal merger announcement occurring before January 20th, 2029.
So slightly better than a coin flip that they actually file the paperwork to announce it within the next 2.5 years.
However, the chance of unconditional completion by that same date meaning surviving the lawsuits, getting the shareholder votes, clearing the Pentagon, and actually swapping the shares holds much lower, at 30 to 45%. The regulatory gauntlet is simply too dense to guarantee a clean close on that timeline.
But if we zoom out, if we look past the immediate political window,
on a 5-year horizon, stretching out to mid-2031, the probability of an announcement reaches 55 to 70%. The brief argues that the strategic gravity pulling these two ecosystems together, the need to build that 6-ingredient carrier bypass network, is just too strong to ignore forever.
There is a statistic in this section that absolutely floored me. When we talk about the gap between an announcement and a completion, M&A deals fall apart all the time. But the brief points out the historical track record within the Musk corporate family.
The track record is undefeated. Inside this specific corporate ecosystem, announced deals have a 100% completion rate.
SolarCity was challenged in court for 6 years, but it closed. The absorption of the original Twitter entity, now X, faced massive legal battles, but it closed. The integration of XAI into SpaceX closed.
History suggests that once the principal decides to endure the pain of filing the paperwork, the resulting transaction is a runaway train. The risk is almost entirely concentrated on whether it gets announced, not if it survives to closing.
Which is why the brief provides a signals dashboard. It teaches you how to separate the smoke from the smoke detectors. Let's define the terms. What is smoke?
Smoke is rhetoric. It is a CEO musing on a podcast about synergies. It is the phrase more and more overlap on a quarterly earnings call. It is YouTube thumbnails and unsourced internet rumors. Smoke is easily manufactured, highly visible, and completely non-binding. It means nothing legally.
So what are the detectors? What should I actually set a Google alert for if I want to know this is happening before it hits the front page?
You need to monitor the leading and coincident financial indicators. The most massive coincident indicator available in public filings is related party revenue.
Meaning, how much money one Musk-controlled company is paying another Musk-controlled company.
Exactly. When SpaceX buys millions of dollars of Tesla megapacks for their launch sites, or when Tesla signs a massive contract to buy Starlink terminals to install in their cybercab fleet, that revenue must be disclosed to the SEC.
Because it's a potential conflict of interest if the CEO is moving money between his own companies.
The trajectory of this specific metric is startling. In 2023, cross-company revenue between Tesla and SpaceX was a relatively negligible $11 million. By 2025, as the hardware integration deepened, it skyrocketed to $573 million. As of the first quarter of 2026, it is on a run rate to cross $900 million annually.
Almost $1 billion a year in internal related party transactions.
The brief sets $1 billion a quarter as the practical structural inflection point. When you reach a certain threshold of financial and operational entanglement, when your product roadmaps are entirely codependent, maintaining two separate corporate boards, two separate sets of fiduciary duties, and two separate compliance departments becomes an administrative nightmare. It becomes legally safer and operationally cheaper to simply merge them.
So we watch the SEC filings for related party revenue spikes. What is another detector?
You watch the state corporate registries, specifically in Texas and Nevada. The brief notes a fascinating historical pattern. Before XAI was formally merged into the SpaceX umbrella, lawyers quietly formed obscure deal vehicle entities, shell companies with generic names, in state registries a couple of weeks before the public press release.
Because you have to create the legal bucket before you can pour the assets into it. State government filings will always leak the reality before the PR department sends an email.
State registries are the canary in the coal mine. But the ultimate alarm, the signal that pushes the probability of a deal instantly above 80%, is the filing of an SEC 8K announcing a definitive merger agreement, or the filing of an S4 proxy statement.
That is the engagement ring at the dinner party.
Furthermore, keep an eye out for a press release announcing the formation of an independent special committee of the Tesla board, equipped with their own independent investment bankers and outside legal counsel. Until you see those specific governance mechanics mobilize, everything else is just narrative preparation.
It is all just setting the table. The smoke thickened dramatically on that July 22nd earnings call, but the fire remains unlit.
And that is the core lesson of the ELG brief: discipline. When you are evaluating information in a high-stakes, hyper-noisy environment, you cannot afford to react to rhetoric. You must apply the loop. You must separate the cold legal mechanics from the algorithmic internet hype.
This has been an absolute masterclass in corporate reality. We've traced the spark from an earnings call, mapped out a massive 6-ingredient telecom strategy designed to bypass Apple, debunked the predatory YouTube hype machine, resurrected the ghost of a 2016 courtroom battle to understand the legal terraforming in Texas, navigated the geopolitical minefield of Washington, D.C., and finally gave you the actual dashboard to monitor the truth.
It really is a phenomenal framework for understanding the modern industrial landscape.
And as we wrap up, I want to leave you, the listener, with one final provocative thought to mull over. It is drawn directly from the reflection questions at the end of Jack Russo's brief. We've spent this entire deep dive discussing the friction, the math, and the probabilities of whether Tesla and SpaceX will formally merge.
Right.
But remember the reality of that Q2 earnings report. Tesla's quarterly operating profit is now heavily supported by the paper valuation of SpaceX's stock. Their advanced silicon is being manufactured in the exact same terafab facility. The Starlink satellite network is currently being hardwired into the chassis of Tesla's flagship robotaxi fleet.
It's incredible when you list it all out like that.
It really is. We keep asking if these two massive companies will eventually merge, but looking at that accelerating, irreversible accounting and operational entanglement, at what point does their separation become the real fiction?
It forces us to question the very definition of a corporate entity in this era. Are we looking at two companies? Or are we already looking at a single unified industrial machine that simply operates under two different ticker symbols for legacy reasons?
Are we just waiting for the lawyers and the paperwork to finally catch up to the engineering reality on the ground? It is a fascinating prospect, and one we will certainly be watching closely through the lens of those smoke detectors we outlined today.
I will be watching the SEC filings right alongside you.
Absolutely. Well, that concludes our incredibly deep dive into the ELG brief on the potential mechanics and strategy of a Tesla-SpaceX merger. Led by Jack Russo, Computer Law Group LLP is a bespoke business litigation and founder-friendly boutique law firm with offices and licensed attorneys in Silicon Valley, New York, and Tampa Bay. And you can reach Jack at jack@computerlaw.com and his team at www.computerlaw.com, where the newsletter we refer to is published in detail and readily available, commitment-free with no paywalls or other charges.
Tune in next time on The Valley Current.